Many of you have been asking us in comments about SEBI margin framework. So here we are to help you decode what's the whole issue about the peak margin system, how will it impact investors, day traders and the overall trading volumes. We'll try and answer some of those vital questions about this new regime in this video, but before figuring out the peak margin framework, it's important to understand what margins are and why SEBI gives it so much importance. Well, simply put, margin refers to the amount of leverage money that a broker can offer clients to trade in securities. For instance, if the transaction value is 10,000 rupees and a trader has put in 50%, then the balance 50%, which is 5,000 rupees in this case, is the margin money. Now coming back to peak margin and what it means. Until December 2020, margin reporting by brokers used to happen only at the end of the day for all the carry forwarded trades executed by the customer on that trading day. Since the margin computations happened only at the end of the day, at times brokers were able to provide higher leverage to their clients. In other words, the intraday swings were not captured in this mechanism. The highlight of the new norms brought in by SEBI from December onwards has been the introduction of peak margin reporting rather than end-of-day reporting. To calculate the peak margin position intraday, clearing corporations would need to take a minimum of 4 random snapshots in the day of all margins. The highest of these snapshots becomes the peak upfront margin of the day. After that, the peak margin requirement would be tallied against the available margin of the investor, and any shortfall would attract a penalty. Now, SEBI has been implementing new margin trading rules in a phased manner from last year. In the first phase between December 2020 and Feb 2021, traders had to pay at least 25% of the peak margin. The margin was raised to 50% between March and May, and it's now 75% from June 1st onwards till August. SEBI aims to raise margins to 100% from 1st September. Also remember, the new mechanism has in effect capped the maximum leverage that a broker can offer clients at around 20%. Now the question is, how do traders stand to be impacted by this? Before the new margin system came into existence, an investor or trader who sold shares today could buy securities worth the sale value immediately based on the available margin, since it would be computed only at the end of the session. Under the peak margin mechanism, the funds available to buy shares on the same day post a sale transaction will be reduced. This is because the margin requirement would be computed during the session, and any price fluctuations would impact the quantum of margin available for a fresh transaction. Moreover, under the new system, investors will no longer be permitted to use shares lying in their demat accounts to make margin payments unless such shares are pledged with the broker after a proper client authorization process. This process of client authorization will take place through email and an OTP, and clients will have to pay a penalty for any shortfall in margins. Intraday trades constitute a large portion of the overall transactions in the stock market, and brokers would now be reluctant to offer higher leverage to avoid the risk of penalties. On the other hand, the new margin system is likely to strengthen the risk management system and make the markets more efficient in the long term. A higher margin requirement ensures that the investor has enough funds to face any potential risk that could arise due to sudden and significant price swings. There is empirical evidence to show that a new framework impacts volumes or trading frequency only in the initial days, and over a period of time, all market participants get used to the new regime and volumes return back to normal levels.